Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 450-something, 440-something. We're not really sure anymore. Who cares? I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance and life insurance adjacent subjects.
Accessories, sir.
Sure.
Yeah, exactly.
We were going to do a podcast about propane, but we figured that was taken.
What's the price of propane today?
There you go.
Yeah.
And today we're going to talk about life insurance and life insurance adjacent subjects. And accessories. We're going to do it. There is a question that comes up often in our universe of looking at insurance products for their cash and income producing capabilities, because we spend a lot of time talking about and showing people how they can use products like whole life insurance and universal life insurance as a way to create retirement income for themselves. And so we also spend a good amount of time talking about the role annuities could play in your retirement income strategy. And this, of course, teases a very important question that a lot of people wonder about. And that is simply, well, which one should I do?
Yeah. And many times it's not even a question they're consciously asking.
Mm-hmm.
It's I think I want to do this. But then when they tell us about their situation, it's like, well, actually, what's going to be better for you is, it might be someone, for instance, that comes and says, I want to buy a whole life insurance policy. Okay, we talk. They tell us what they want. It's about income. And they're like, but I need to start it in 2 years.
Yeah.
Or 3 years or 4 years or something like that. And maybe they're in their 60s. I'm just, sort of putting together an amalgamation of various scenarios we've seen. And you go, well, that's probably not going to work out all that well for you in that situation. And here's why. But maybe an annuity would be a better fit for you. And vice versa. We might have someone who comes with a different set of circumstances that wants to look at annuities and like, well, actually life insurance would be a better tool for you given your particular set of circumstances.
Yep.
So, that is a question that we deal with on a regular basis, for sure.
Mm-hmm. So I want to take a step back, and I just want to address the topic of income being generated with life insurance for a second, because there are plenty of people who regularly listen to the Insurance Pro Blog podcast who have an idea about how that works, but there's always new people coming and going. And so I want to address this subject because it is somewhat lesser known. That's understatement of the year for the podcast. And it is a little bit confusing to people. So when you own a certain type of life insurance, cash value life insurance is the broad category, but this could encompass things like whole life insurance or universal life insurance. And when you own one of those products, the payment of premium in general will build cash in the policy.
Mm-hmm.
Now, there are lots of things that you can do to make that cash grow faster. That's a topic for another day. But the buildup of that cash is representative of value that you hold.
Right.
And you have the ability to use that cash for some purpose entirely up to you. And one of the things that you can do with that cash is start taking kind of systematic distributions from the life insurance policy in retirement. And one of the main attractive features of life insurance, the reason some people choose to do that, is that life insurance benefits from a few different tax favorable attributes. And the chief one here is the fact that you can create distributions from a life insurance policy that end up not incurring an income tax liability.
Correct.
So the strategy here is we can build up a sum of cash, but we can also use that value for retirement income. It does not add to our tax liability, and it doesn't add to our tax liability in virtually any way that we might have a tax headache when it comes to retirement income planning. So it's not recognized as an ordinary income distribution. There are ways that it has to be done in order for this to work out. So I don't want to make that as a blanket statement and make people believe that it's just an automatic thing, though it's pretty easy to orchestrate. So it does not add to your reportable income as a retiree taking distributions from wherever your other assets sit. But it also doesn't impact your provisional income, which means it does not impact the taxability calculation of your Social Security income.
Right.
So it has those two very cool and very beneficial tax aspects to it. In addition to all of that, most, with the exception of variable styles of cash value life insurance, variable universal life insurance would be the product these days. So most cash value products, whole life insurance, indexed universal life insurance is what would typically encompass this statement as well with universal life insurance. Those products are very, very stable in terms of their year-over-year rate of return, and they do not participate in any sort of risk-based market investment, which is which means that there's a stability to the balance of cash or balance of value, which does give you a higher degree of predictability when it comes to the distribution from the pile of cash that you have accumulated in life insurance policies.
Correct.
So unlike perhaps your IRA that is sitting in 60% stocks and 40% bonds, there is the potential for volatility. You may experience a year where your account values drop, let's say 10%, which might create some anxiety over how much money you should now be distributing from your IRA.
Right.
That does not exist when you
own life insurance. That doesn't be a concern
insurance
that a lot of people have, but it is a concern that most people should have.
Yeah.
I'm going to say that.
So life insurance brings these things to the table. Now, annuities, which are also fairly misunderstood. I think if you were to pull somebody randomly off the street and say, what is an annuity? Most of them would probably mumble something about income in their answer, because annuities are usually synonymous with income.
Right.
But the functionality of how it does that is varied depending on the type of product. But for the most part, people do come to understand either on the surface or through a little bit of research that annuities are financial products that are specifically designed to provide income to someone.
Right.
And they do that in a way that seeks to remove, again, a substantial amount of this volatility aspect that I talked about with your kind of traditional IRA 60-40 stock bond portfolio, whatever the composition is. So annuities provide income, most generally guaranteed income, that totally disregards the cash balance of the annuity, if there even is one.
Right.
So,
and there's a lot of extra details in that. There's a lot of explanations about annuities, and we've done those podcasts, so you should go back and listen to them.
Yep. Now, given all of that, we now arrive at the question, well, which one should I use when? And the general
Please enlighten
answer,
us, Brandon. Tell me.
The general answer. Life insurance is an option that you can use. It's going to require, in most cases, a good bit more forward thinking. So if you are 65 years old and you plan to retire next year, it's going to be tough to buy a life insurance policy and turn that into income when you retire.
Right.
It's going to be practically impossible for that to happen.
Yeah.
And so,
can I put a caveat? It's going to be impossible for it to make sense for you to do that. It doesn't mean you can't do it. It just mathematically.
Yes. Because with life insurance, first, we got to get the money into the policy.
Right.
And that's not generally going to work very well if it happens all at once.
Right.
So we need a few years to get however much money is going to go into the policy in there.
Yes.
And then there's a certain strength to insurance that develops over time. And life insurance is going to need that time. So, in general, I would say no earlier than 10 years after the policy is purchased should you be thinking about using it as a source of income.
Right.
Annuities don't have...
And we should add, one of the big reasons for that is because in most scenarios, not all of them, but in most scenarios where people are looking toward their cash value life insurance policy to provide retirement income for them in the future, they have no plans to pay it back.
Yes, correct.
And
correct.
There are structural reasons why that wouldn't necessarily make sense for someone who was much younger to do that early on. But again, we've talked about that before.
So annuities don't have this issue of needing some sort of percolating time period.
Yeah.
They are designed
life
to
insurance
start
is more of an income crockpot. And and annuities are more of an income microwave.
There you go. So annuities are designed for the most part. There are a couple of exceptions here, but
yeah, absolutely.
Most annuities you could purchase today and start income tomorrow is a little inaccurate, but a month from now.
Yeah.
And they would provide you with a guaranteed income stream for the rest of your life.
Right.
Or possibly the rest of yours and your spouse's life.
The big thing with annuities is that you can find a product that will work for your scenario in that, whether it's, 6 months from now, a year from now, 5 years from now, 10 years from now, there's a product that will work. That doesn't mean it may not do what you want it to do, but it will work.
Right. It will provide guaranteed income.
Yes.
The degree to which that guaranteed income is compelling enough to actually buy the annuity, that depends on circumstances.
Right.
So the really, 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 really simplified version of this is if you are trying to take income under 10 years from now, annuities. If you've got more than 10 years, life insurance could make sense. But don't overlook the fact that annuities could also make sense.
Right.
Now, there are other sort of careful revisions to this. If your money is sitting in an IRA, for example, you're going to have to buy an annuity. Otherwise, you're going to have to take the money out of the IRA because life insurance
do something else. You're not going to buy life
IRA.
Insurance.
Yes, correct. So that's one area where you would kind of default to annuities.
Right.
I would also point out that we use the example of the 35-year-old or 65-year-old looking to retire a year or two from now. The 40-year-old who's looking to retire 25 years from now, you could buy an annuity. You could. But there's a lot of advice that would probably push you away from that. And the main reason
it depends on the scenario. But
the main reason being that if you are focused intently on the income benefit of that annuity, a lot of them do not bring much to the table if you're going to defer income for that amount of time.
Right.
There are some, but a number of them tend to stop creating additional income benefit that is substantial after roughly 10 years. That's a fairly broad stroke because there are exceptions, but that's the kind of that's where the majority of products exist.
The exceptions that I've come across for younger, let's just say someone who's 45, like you gave the example, is they got money in an IRA. That's sort of one checkbox. They're very risk averse.
Yep.
So they like some sort of guarantees on principal. And they probably don't need an annuity at that stage with an income guarantee because of the additional cost and drag on overall return. And they'll be able to reposition that into a different annuity that has better features for income later. Did that make sense?
Yeah. So that opens.
I realize that's a specific set of circumstances, but we have run across those people. So.
Yep. That dives down a different rabbit hole, but since we do that here, let's do it. So, not all annuities necessarily exist for the purpose of providing income.
Correct.
They do have the capability, but it's really not the plan for that to take place. There are some annuities that exist with the intention of simply being a store of value.
Right.
They have a cash value, they earn interest, and that interest accumulation will most likely be transferred out to something else in the future.
Right.
But it will not be the case.
Into an annuity with an income, with a more substantial income benefit. It's hard to explain this without understanding the annuity marketplace, but there are products that are engineered more for accumulation and products that are engineered more towards guaranteed income.
Yep. There are. And the ones that are geared towards accumulation lack the income producing features.
Right.
That the annuities that are geared towards income would generally have.
Yep. Exactly.
And so that's and your point here was to basically say, well, if you're looking for an annuity simply as a conservative option,
right,
because you don't like the risk of the market, you've seen what's happened to the bond market when interest rates change in a direction that doesn't follow the trend we've seen for almost 30 years, or even does follow that trend and still doesn't work the way it's supposed to. So you'd like to bring risk of loss all the way down to zero.
Right.
And the savings account ain't cutting it for you.
Right.
So annuities do bring a potentially higher interest rate to the table, and they can accumulate in a very conservative way while also removing the risk of loss from a down market year. And again, there is still an income feature to most of those annuities, but almost no one uses them.
Right.
But since it's all called annuities, it does cause some confusion for people to look at and say, well, wait a minute. When somebody is younger, so the 45-year-old, 40-year-old, 35-year-old, and does have a longer time horizon before they intend to retire, life insurance can certainly bring a lot to the table. And it can do it in a multitude of different ways. So if you are a 45-year-old who intends to retire sometime between 65 and 70, life insurance is going to have ample time to grow value.
Right.
And definitely be capable of producing income.
Mm-hmm.
But if plans change and you retire earlier, or even if you're a 45-year-old who plans to retire at, let's say, 60, there may be some things about life insurance that make it more adaptable and a better option than an annuity would be.
Right.
If you're even younger, let's say 30 years old, with a very high capacity to save and a desire to retire at age 50, life insurance could bring a lot to the table as well, because with annuities, taking income prior to age 59 and a half is going to involve some degree of tax complication.
Right. Mm-hmm.
The tax benefits that life insurance enjoys are not the tax benefits that annuities enjoy. Distributions from annuities are, even as if they are owned solely as an annuity contract and not inside an IRA, they are recognized as ordinary income to the degree that gain is being distributed from the annuity. And it must be distributed before the cost basis, the money you put into it, comes out.
Right.
So this creates an income tax consideration.
Right.
And annuities do fall in the category of retirement products like IRAs, and they're subject to early withdrawal penalties. So or early withdrawal penalty taxes, rather. So a withdrawal from an annuity prior to age 59 and a half could carry a 10% excise tax penalty as well.
Right.
And so if the plan were to retire prior to that age, an annuity would be less ideal as an option.
Yeah. If you had to pick between the two.
Yep.
Ideally, having both would be fantastic.
Well, therein lies yet one more piece of this that we haven't addressed, which is, which should I do? The answer could always be both.
Right.
And there are a number of clients that we have now who own both.
Yeah. Absolutely.
And the very, very...
all part of their income multi-layered, multi-step income strategy.
Yep. And the overly simplified example for why they choose to do both is they can rely on annuities to provide guaranteed income no matter what happens.
Yep.
And while life insurance can produce income that is pretty close to that stability, there are guarantees that annuities have that life insurance doesn't have regarding annuities. Regarding income.
Right.
So while the income from
because life insurance not specifically designed to produce it. I mean, from a product manufacturer, life insurance company perspective, life insurance policies are not engineered for that purpose. They happen to work for that purpose, but
and there is some degree of variability to the accumulation of value in a life insurance contract. Dividend rates can change on whole life insurance. Index earnings vary depending on what's going on with the underlying index.
Right.
So there is a chance that things vary to a degree that the original income projection has to be modified.
Sure.
Generally not by much, but it's not a probability of zero. That is the case with a number of annuity contracts.
Yeah.
There are annuity contracts in existence today that we are very familiar with and use constantly that will allow us to say, for any sum of money you want to give the insurance company, we can guarantee you 5 years from now, 8 years from now, 10 years from now, whatever it is, and you don't have to choose right now. We can guarantee you this is the income that you can produce by virtue of giving the insurance company that sum of money today.
Right.
We cannot
on a guaranteed
make that,
basis.
Yep. Yeah. Cannot make that same statement for life insurance.
Correct.
So,
and to me, that's a further illustration of why it needs more time, life insurance, because if you got a short time horizon, variability is not your friend. If you got a longer time horizon, you've got a greater chance of a reversion to the mean.
Yeah, variability tends to get smoothed out.
Yeah. So you could be a lot closer. In other words, you could have bought we'll just use whole life as an example. You could have bought a whole life policy back 10 years ago that's paying was paying a higher dividend than it's paying now. Now, that doesn't mean 10 years from now it won't be paying a higher dividend than it was paying 10 years ago. Maybe it will.
Right.
I mean, that's it. A thing we all often share with people when we do income illustrations in life insurance policies is the one thing we can guarantee you is this number will not be the exact number.
Yes.
It's an illustration of conditions as they exist today.
Yep.
But it's not going to work out perfectly like that. I know it looks like it on this piece of paper, but it's not going to work out perfectly that way.
Right.
It doesn't matter if that's indexed universal life insurance or whole life.
No, it doesn't make any difference. So there are times, though, because the way that we're discussing this almost seems like there's an inferiority to life insurance. There are times that what we would expect to happen income-wise from the life insurance policy will be a greater bang for the buck in terms of dollars in income coming out on the life insurance policy than would be on the annuity.
Especially when you look at the net after tax.
Yep.
number.
And that then comes down to assessing, well, what are the odds that the income projection will change? And by how much? Because if the annuity is telling me that for whatever dollars I'm putting into this, I'm going to be able to produce $50,000 of income every year, starting at age 65. The life insurance policy tells me that I'm going to be able to produce $75,000 of income. Well, first, there's the fact that $50,000 is taxable and $75,000 is not taxable. And if the life insurance policy is wrong, it needs to be adjusted down. It needs to be adjusted down by a lot before the net is the same as the annuity contract.
Right. It'd be a huge jump.
Yep. And also, with most, again, there are some exceptions, most annuity contracts, the guaranteed income number is a locked-in number for life. So the good news is you know exactly what you're going to have. The bad news is over time, the buying power of that income is going to go down because of inflation.
Right.
Life insurance, on the other hand, does have the possibility of things working out better than expected and income being increased because the policy is outperforming expectations.
Right.
And the nifty thing about life insurance contracts is because they are pretty tightly connected to the bond market, and bond yields are pretty tightly connected to the interest rate market, and the interest rate market is very tightly connected to inflation. If we see higher inflation, we generally see higher performing life insurance contracts.
Yep. Depends on how long interest rates stay at a higher level and various things there. Well, one thing I think we should mention, and we don't talk about enough, actually. I think we've mentioned it before, but it's good to bring it up again. And that is whether you're looking at an annuity or you're looking at life insurance and you're looking at income numbers. The numbers that you're seeing typically, whether that's, with us or any other advisor, I would, at least in our experience and what we've seen out there, is you're seeing the maximum numbers.
Okay.
You don't have to take the maximum if you don't need it.
No, you don't. And you don't have to take the maximum in either case.
That's what I'm saying.
Yep.
And anytime you take less, you extend, either in the annuities case, how much longer you can take the money, or in the life insurance case, the fact that you might be able to take more later.
Yep.
By design. Well, actually, in the life insurance case, you would be able to take more later by design. So.
Yep. That we had an entire episode that talked about the dynamic income aspect of index universal life insurance and addressing this very subject. That you may have the number that would be kind of advised that you take as an income stream, but you may look at that and go, well, I don't need that much money, so I'm not going to do that. And the result is a pretty substantial ability to increase income over time.
Right.
Now with annuities, you can opt to forego some of the income it produces, with a couple of exceptions. SPIAs, no. Anything that is annuitized, no. But when it comes to annuities that have income riders, these are fixed indexed annuities and variable annuities, you do have the option with a lot of contracts to say, well, it tells me I can take $50,000 of income from this annuity, but I only need 30. So I'm going to leave $20,000 behind. You can do that. And with most products that allow that, what you do is that $20,000 just sort of sits, and at a later date, you can choose to take that additional $20,000 that you didn't some time ago as a distribution.
And just imagine if you did that for years.
Yep.
And you're adding on. So.
Correct. So
yeah, I just that came to mind in the context of thinking about inflation.
Yep.
Because a lot of people are concerned about that, especially after the last several years. They're very concerned about it. I mean, for a long time, you and I, would talk about the fact that inflation was relatively innocuous for a number of years, and then it changed.
So super simplified, income now, annuities, income later, life insurance or annuities, income a good bit later, life insurance tends to have a leg up. Taxes complicate all of this though, and tend to shift around where exactly one is the right choice versus the other.
Correct. So is that clear?
And that's all I have to say about that.
Now that we've clarified the subject by adding more variables, you're welcome.
Just go back and listen to it again. And again and again and again. That's how we get our 5 listeners. That's how we get our 5 listeners up to like 15 downloads.
You said we got people coming and going. I was like, I think we got more going than coming. But hopefully someone will find some value in this.
Yeah. Well, if you don't, remember how much you paid for it.
That's right.
There you go. And on that note, I am Brandon Roberts.
And I am Brantley Woodley.
And we will see you next week.